Just a reminder, nothing I share here is financial advice. This is all based on my own experience, my strategy, and how I see the market. You're responsible for your own trades, so always do your own research, manage your risk, and never trade money you can't afford to lose. This content is meant to help you learn and think for yourself, not to copy or follow blindly. Let's keep it educational and intentional. Hello, guys, and welcome to the White Rabbit Show. Just joking. I mean, the Rabbit Trading Channel. If you know, you know. Now let's take a look at one chart, and that is the sell model. Here we're looking at two possible scenarios. First, we focus on ranges and market moves. In the lower example, we can see a range, followed by a move up, then another range, a move down and back up, and again a range forming at the top. After that, price steps down. First step, second step, and then a third step lower. The picture almost explains itself. If we strictly follow this model, we would simply expect another low to be made. Looking a bit closer, however, this blue range is not really a clean range. Of course, that always depends on who is looking at it, but to me it looks more like a range that already broke down, similar to the structure shown in the upper example. So yes, I can be wrong, and we could still see another leg down. I already showed that there are support areas below. The power law model is approaching the 50K region, so technically a move lower is not impossible. It would also align with the typical 70 to 80% bear market drawdown scenario. However, I've also shown over time that price is already very close to several historical bottom metrics and tools. One of them is the Bitcoin production cost, which historically has marked bottom areas. In previous cycles, bear market retracements of 70 to 80% aligned closely with price returning to production cost levels and other long-term metrics. This time is different. The top formation was relatively silent and not as explosive as previous cycles. Because of that, the drawdown to production cost is currently only around 50%. Historically, price moved 70 to 80% down into these zones, but now we are already reaching them with a smaller decline. If we study past deviations, price sometimes wicked below production cost, roughly 20 to 24% at maximum, before forming the final bottom. Applying that deviation today would place potential downside around the 47K to 50K region, which also aligns with power law and other long-term tools as a worst-case scenario. Importantly, whenever price traded below production cost historically, it happened during bottom formation, not during continuation of a long-term collapse. Another interesting observation: moves below production cost tend to be highly volatile. Price either quickly reclaims the level or consolidates around it before reversing. Historically, we've seen two outcomes: accumulation below the level followed by recovery, or failure to break down further, marking the cycle low. So what does this tell us? It suggests that this cycle will likely show something new. Either we get the traditional 70 to 80% drawdown, breaking multiple long-term metrics for the first time, or these historically reliable bottom zones hold, meaning for the first time, we do not see an 80% bear market decline. In both cases, something changes compared to history. Now looking at the upper sell model, I approached it differently. Instead of treating the entire structure as one range, I restart the analysis after the breakdown. From there, we see a cleaner sequence: range, breakdown, new range at the top, retracements, and now what appears to be the final phase, sideways movement with potential upside. Importantly, this structure already sits at production cost levels, historically associated with bottoms, even allowing for some deviation. If we start seeing strong impulsive moves below this range, then of course the lower bearish scenario becomes more likely. In that case, we would wait again for a new range to form before calling a bottom. But for now, range behavior combined with historical bottom metrics makes the upper scenario more attractive to me. Personally, I don't have a problem if this cycle does not produce an 80% drawdown. Many market participants expect that outcome simply because it happened before. But markets evolve. The data currently suggests that this top was not a classic one, and logically, that could also mean we won't see a classic bottom. Of course, I could be wrong, and that's fine. My management accounts for that. In the worst case, it's a losing trade, or I accumulate Bitcoin slightly cheaper. I'm simply positioning based on probabilities derived from historical data and tools. So this sell model presents two valid options. One scenario aligns with traditional cycle expectations and deeper downside. The other aligns with historical bottom metrics already being reached. Both remain active, and it's up to each of you to decide which framework you want to follow using your own tools and analysis. For me, I follow my plan step by step. I haven't sold my spot positions. In fact, I added more through multiple rabbit box setups and additional spot buys. Future entries will follow the next stages of my plan, which I'll share when the time comes. Best case, we see only a deviation or wick lower, not a full breakdown. Because if this range truly breaks down with impulse, then the door opens for significantly lower prices. So that was the higher time frame sell model overview. Now let's move to the local range. Here we have our range low, range high, and price trading inside it. Following the sell model discussed before, my preferred outcome would be for this range to eventually break to the upside. Of course, I acknowledge that lower targets still exist and that the weekly structure remains in a downtrend. Because of that, I also take shorts at the range highs and keep some runners in case price doesn't just wick the lows, but instead makes an impulsive bearish move lower. In that scenario, those shorts would target lower levels. Even if it's not the macro market top, it's still a technical trade that can generate profit. On the long side, I also keep runners while managing positions step by step through the levels. That means I'm looking at support zones around the mid-range, the lower part of the range, an internal SR level, and finally the overall range low. These are the typical zones of interest where I look for reactions and setups. So for now, if price moves back to the range low, I would look for the next long opportunity, or potentially another SFP of the current low. As we can see, there isn't much structure in between, so it's either another SFP at this level or a retest of the range low where I would again look for longs. If price breaks down impulsively, that becomes an invalidation, and I would shift focus to the next higher time frame levels already marked on the chart. The same logic applies at the range high. If price reaches the top of the range, I'll look for weakness, such as an SFP or deviation, as a potential short setup. The short idea would be locally invalidated if price manages to hold above the range and reclaim the monthly swing low. In that case, I would aim for the next SR level and the higher structure swing point. So as you can see, the process is symmetrical to the long setups, level by level, reaction by reaction. And with the monthly open coming up soon, that will also become an important reference level for the next move. So if we get a move up from here, for example, and the next monthly candle opens, in most cases, the new month first forms a wick. In a bearish scenario, that would mean an upper wick. In that case, our higher targets could be hit first, followed by a move down, where shorts would likely play out back toward the range lows, or even lower, depending on what the new month brings. The alternative scenario is a move down first, forming the monthly low. In that case, shorts could initially work, but at some point they would likely get stopped out if the range eventually breaks to the upside. So in the end, everything comes down to this range and whether you believe it will break up or down. On the higher time frame, we can also see that Bitcoin is currently retesting a previous all-time high and the prior range that existed before new highs were made. This is a major area, not only price-wise, but also historically. If price breaks below this level, then for the first time, such a large structure could turn into resistance, opening the door for significantly lower prices and supporting the second sell model scenario. However, if this area holds as support, which is exactly what is being tested now, then we are more likely looking at the first sell model, where price is already at or near the lows of the move, aligning with multiple data points suggesting a bottoming area. Time-wise, we are currently inside the 202-day cycle, with the projected low date around March 2nd, roughly aligning with the upcoming monthly open next week. Cycle-wise, this period usually brings volatility. In a bear market, it can produce a temporary move before new lows. But at the end of a larger structure, it often leads to a stronger rally and reversal, ideally forming a higher low afterward. That would align with the 4-year cycle and several other tools and metrics suggesting a higher low formation, something that would surprise many participants. So again, either we see something new because metrics hold and prevent the classic 80% drawdown, or we see something new because those historical metrics break for the first time. Either way, the market is likely to teach everyone something this cycle. Now, since this is a trading channel, we move from analysis to execution. I don't just show charts where price could go up or down, I also execute based on a defined plan. The goal is to demonstrate that charting alone is not enough. Technical analysis without execution is mostly useless. There are many people who are excellent at drawing charts but struggle with execution. That's fine, but personally, I wouldn't follow trade ideas from someone who cannot execute their own analysis. Often, people share charts after moves already played out, which makes everything look smart in hindsight. But that doesn't help anyone trading in real time. If someone posts a chart with arrows or wave counts but never shows execution, risk management, or invalidation levels, how useful is that to you? After a month, price moves and the drawing looks correct. But did they actually trade it? Usually, multiple conflicting scenarios were shared, and only the winning one gets highlighted afterward. That leaves followers with information, but no decision-making framework. Over time, many traders end up following dozens of analysts, collecting more and more lines and indicators, yet never learning how to actually trade. They remain stuck in endless learning instead of developing execution skills. So here's a simple tip. Whenever someone shares a chart, ask for the plan. What is the action? Where is the entry? Where is invalidation? Where are profits taken? If there is no clear execution plan, then the chart has little practical value for you. Drawing levels is easy. Markets will always react to levels in some way. But without a management plan, execution rules, and risk control, it's just another drawing added to your chart, creating confusion instead of clarity. With that said, let's move on to the next chart and the local range trades. Here we have this range and several trades that were taken inside it. I won't go through all of them again, because over time I continuously updated what I plan to do. In the previous video, I was already watching this level and had planned to trade it either with a single entry and wide invalidation, or step by step using local management. All of these approaches are valid, and over time I've shown each of them. However, within this range, I'm no longer keeping my invalidation below the major low like I did in the upper range. The reason is simple. After the breakdown, the weekly time frame officially shifted into a downtrend. Because of that, I'm no longer using the same wide invalidation approach. Instead, I'm now working with local invalidations. Yes, I could simply take one long and wait for 73K, but due to the confirmed weekly downtrend, I prefer to secure profits earlier, pay myself along the way, and move trades into risk-free positions as soon as it is technically justified, usually once an important support or resistance level is reached. That's exactly what happened with this trade. The first long reached TP1, and later the invalidation was hit, but thanks to profit management, the trade still closed without a loss. After that, I took another entry from the same zone, which I also updated live, either by sharing the limit in advance or announcing the manual execution. This latest trade has now reached TP4, making it fully protected, with around 1.6R already secured and roughly 27% still running. I'm trying to keep as much size as possible for the main target. Even if I close the trade now, the result would already be strong, but ideally I want to realize larger profits closer to the overall target. From here, the plan is to take another portion around 71K, followed by the largest take profit near the range high, while still leaving a small runner around 10 to 15% in case price does not reverse and instead continues higher after only a shallow pullback, similar to what we discussed regarding monthly candle behavior. In a bearish scenario, price could still move higher first, trigger shorts near resistance, and then rotate back toward at least the mid-range. If that mid-level gets lost afterward, I would begin targeting new lows step by step. For now, these scenarios are simply preparation. Once execution becomes necessary, I will update accordingly. At the moment, there is no action required from me. My next long action would only come below my entry again, either on an SFP or at the range low. If price continues higher, my job is simply to hold the trade. I waited 2 weeks for this setup. Now execution means patience, paying myself along the way, and letting the trade play out without jumping in and out. Of course, we still have intraday levels in between. I use them mainly to observe strength or weakness. They can cause reactions, but since I already hold a position, they do not require additional action. And this is an important point. A level without a predefined action is useless. A level only becomes valuable once you know exactly what you will do there. For example, this mid-range area remains important because price has already reacted there multiple times. 3 reactions in total, 2 of which I traded myself. That keeps it relevant. The difference now is that I'm no longer using it for entries, but for trade management, helping decide whether to hold or reduce exposure. We also have today's average loss level in this area, which adds technical significance. Still, there is no new action for me unless the level is lost. Ideally, I would prefer price to remain above the weekly open. If price moves below and then bounces, that level becomes resistance. A reclaim would favor continuation higher, while rejection could become an action point, either taking profits on longs or considering shorts. For now, it remains purely a management level for my existing trade. Best case, price holds here and continues toward the target, where I'll take further profits and share the next execution plan. With that said, I hope this update was helpful. If you'd like more detailed content, feel free to join the Patreon. And until then, have a great day and see you in the next update.